Hi everyone, this is a message from Brent Pasqua. The coronavirus has continued to wreak havoc on both the market and the economy. And currently, right now, we're having tremendous declines in the market and a lot of volatility. But the question that a lot of people keep asking is, what should we do in a market like this? Well, you really have a couple of options. There's really three main options, and we'll add in a fourth that you really shouldn't do. Number one, you could take the conservative approach. The conservative approach would be to do absolutely nothing. Hold your allocations the way you are. For example, if you're sitting in a 60% stock and 40% bond portfolio, and we've seen those allocations drop since the market started to fall, maybe now they're 55, 56, or even 54% stocks, that doesn't mean you have to do anything. We could stay just the way you are. This is what I would consider a very conservative approach. Letting your allocations ride, sitting, waiting, and in a while, once the storm passes and we recover, the market and your portfolio will go back to the way it was. It is going to take some time, and being conservative right now will allow it to take a little bit longer to recover, but it's the most conservative approach. Many people feel comfortable taking this type of approach. But if you said, you know what, the market is down and I want to do more while it's down, we could take a proactive approach. What would the proactive approach be? It would be to rebalance. Rebalance means that if we still were talking about that 60% stock, 40% bond portfolio, and academic research shows that we rebalance when we're down about 6% from our target allocation. So when we got to somewhere around 54% in stocks, we would pull it back up to 60% in stocks. That means, though, that we're asking you to take a little bit more risk. We're telling you to go more into stocks after you've just seen your stocks fall for the last 3 weeks. And yes, it's come down fast in 3 weeks. However, taking this approach allows it to recover faster once the market starts to recover. This is something that we would consider a very proactive approach, but a very educated approach, because academic research shows that when you get higher on those allocations or lower in those allocations, we want to rebalance. It's a strong investment fundamental. This is the approach we'd like to take with many people who are comfortable with being proactive with the portfolio. It's not for everyone because you are taking your risk back up to where you were before the decline. But again, it gives you a good opportunity to make money on the upside. Remember, stocks are cheaper than they were 3 weeks ago. The other alternative would be the aggressive approach. Aggressive approach means that you start adding money. Why is that? Because now as the market continues to fall, we can keep adding money into the portfolio at different points in the market as it continues to go down. As it continues to fall, we keep adding in more money. What happens is when market starts to turn up, your entry point of where you bought into the market, you pass that right up and you're able to start making money. Again, things are about 30% cheaper than where they were 3 weeks ago. If you can buy a car right now that's 30% cheaper than MSRP, chances are you'd probably go and buy it. So right now isn't a bad time for you to add money if there's money sitting in cash, money sitting in savings, money not earning a very high interest rate, or money that you could just add monthly are all great points in time for you to now start making money on the aggressive side as it starts to come back up. Again, you're being a little bit aggressive because you're putting money into the market when it feels like all the market keeps doing is declining. However, over time, you'll see it rapidly start to hopefully increase as the market starts to bounce up. But what is the big no-no? A big absolute no-no is to sell everything. That's how people lost a lot of money in 2008. That's not a winning proposition. Getting out of the market right now isn't going to help you at all. All it's going to do is make you capture the losses. So we suggest, obviously, staying in, taking one of the three approaches. But are there some things that you can do to help along this path? Of course. Right now, some of the things that you can do is spend less money. take a little bit off of your expenses that you're used to spending. And right now, just the way the situation is falling, we don't really have a choice. A lot of us are going to be spending less money. We're going to be staying in more, going out less, not having much to go spend money on. So naturally, you're probably going to spend less money. But if you want to think long term and bigger, why don't you reduce some of the unnecessary expenses? Cut big ticket items. What would those be? If you're planning big expensive trips this summer, chances are they either aren't going to happen or you're going to be able to get them for a lot cheaper when they do start to be able to happen. If you're planning on purchasing a car, maybe wait till the following year. You're thinking about doing home projects, again, maybe wait till the following year. Chances are that work is going to get cheaper over time because we're probably heading into slight recession. It could be a short-term recession, but it's going to affect different industries. And if that's the case, then work will probably get a little bit cheaper that you are intending to do. So my suggestion would be is maybe hold off on those big ticket items. The other thing that allows is maybe it allows you to hold off on taking big withdrawals from your portfolio during this time when the market's down. It's never a good time to take a money out of a portfolio when the market starts to decline. The other options that you have is make contributions into your 401k. Continue those. If you have your IRA, your 401k, if you're allowed to make contributions into those plans, continue making them or make those big IRA contributions. The reason why is because you're able to buy stocks at a very low price. One other suggestion would be to make your contributions 100% into the stock portion of your 401k or your IRAs. What does that mean? Don't change your whole 401k contributions to stocks, but just make your new money contributions, the money that you're just adding, just to all into stocks. So just like as the previous approaches, as the market starts to come back up, so will your money. Another thing, maybe take down your withdrawals in your portfolios. It's a very helpful way to minimize the positions having to be sold in your portfolio. Taking less money out of your portfolio during a down market can extend the life expectancy of your money multiples. But that doesn't mean you have to do it. It's a great opportunity or time for you to do it if you can reduce your expenses. Does this market decline change your life? And the answer to that is absolutely not. It does not change any of your long-term goals. Keep focusing on those. Now, I know you can't go out and do all the things that you were doing before, but continue to focus on the big picture and long-term. In 2, 3, 4 years from now, we'll forget that this even happened, except for the fact that we all went through it. The money part, though, will be recovered. But I would not change any of your long-term goals. It does not change your long-term goals for another good reason. Because we have bonds in the portfolio that we're using for your income. So if the market does continue to fall, the money that's in the stocks, we're not using any of that now, and we don't plan on using that for a very long time. The money that's in the bonds is the money that you're going to use for income, and the bonds have done very, very well over the last 3.5 weeks. So remember, the income that you're generating now is all very safe. And the money that's long-term is the part that's getting hit really hard. Remember, you have to separate those two out. Bonds, safe for income now. Stocks, losing, but they're not for a long time away. One other thing to close with. If your house was worth 30% less today than it was 3 weeks ago, would you call your real estate agent to put your house on the market? Probably not. So my suggestion would be hold tight, sit tight, because we're in this for a while. This is a storm that's going to last a little bit, but it's for our health, and hopefully it happens quickly. We can move past this, and then by the time we move past this, we can really start rebounding. We look forward to continuing to communicate with you as we start and continue to weather this storm, and we will. If you have any questions, please feel free to call us or check out any of our communication. We're sending out podcasts, We're sending out our blogs, emails. We're keeping our clients up to date with these videos. So we are here for you, and we'll continue that. We look forward to talking to you soon.